Hello and welcome to this Fiera Real Estate webinar on why and where to invest in UK real estate. I'm Damian Wild. There's no real estate market in the world that has been immune to challenge over the last 18 months. Questions around the future of physical retail have gathered pace, while more unexpectedly perhaps, the very future of the office, at least as a 5-day-a-week destination, seems to be in doubt. In the UK, to COVID, add Brexit, which has intensified challenges. But has it shaken investor confidence in a market where stability has always been such a major draw? And does a post-Brexit UK make for a compelling investment opportunity? We'll be finding out over the course of the next 45 minutes or so with a panel of expert speakers. I'm very pleased to be joined by Jenny Buck, Chief Investment Officer at Tesco Pension Investment, by Alex Price, Chief Executive of Fiera Real Estate UK, and by Matt Oakley, Head of Department for Commercial Real Estate at Savills. But before I get into the meat of today's session, I would just like to go through some general housekeeping regarding the webinar software and how to use it. We're recording and your line will be on mute throughout, and a replay will be available 24 hours after the call using the same link that you were provided for this call. Now, the webinar console which you're looking at can be completely customized. You can minimize and move any of the windows you have open, and you can submit your questions at any time via the question and answer tab, which is located at the bottom of your screen. And for those of you who've joined on a mobile, in order to submit a question, you will need to click on your screen and a banner will appear at the bottom of the page with a purple Q&A button. I hope all of that's clear. I'm sure it will become clear during the course of the discussion. And please do submit questions throughout, which you should see a facility on screen to do so. So that's the housekeeping out of the way. And before we get to your questions, and to mine as well, we're going to hear from Matt, who's crunched the numbers on the market outlook for 2022. Matt, can I hand over to you?
Thanks, Damian, and good afternoon, everyone. And many thanks to the team at Fiera for inviting me to introduce this afternoon's session. I'm going to resist the temptation of a lifetime and not go on for the full 45 minutes if I can, and just try and distill some what I think are some of the new and old challenges ahead, particularly for investors looking inward at the UK. And I guess, you know, let's start from the very top. COVID has left the world with some very big economic challenges, and I could do probably 20 minutes on each of these two charts, but won't. All I would say that in the context of real estate investment, I'm not worried about consumer price inflation at the moment. In the context of real estate investment, I am slightly worried about the general indebtedness of pretty much every major country in the world. I think it is very hard to conclude that we are not facing a period of lower than expected public spending and higher than expected taxation going forward. But that's enough macroeconomics for any immediately after lunchtime session. The one other thing I'm going to say on that front is, you know, many of these issues, most notably the inflation issue, are going to burn off for the rest of the world over the course of early and next year. They're all broadly linked to the fact that the whole world essentially came out of lockdown simultaneously and started beavering away again. I'm afraid the UK has an extra challenge of its own, which is going to delay particularly the inflation point of view. Brexit hasn't been done, despite what Prime Minister Johnson would like to make us believe. And the biggest challenge is really for the service side of the UK economy, which is the biggest side of the UK economy, and particularly for the office market. I think the fact that we have failed to even come up with a memorandum of understanding on financial services equivalency is a big concern. It shouldn't be that difficult. The EU already has similar agreements with both the USA and Japan, and I'm afraid COVID has been a very good reason for us not getting agreement on this to date. I worry that politics is going to be a less good reason for us not doing this. That having been said, if you've been perusing the GDP growth chart, you can actually see the prospects for next year for the UK economy are very, very good indeed in the context of the other major global countries. Slightly a factor of the fact that we went down further, so therefore we will come back stronger. But I think if I was going to leave you with one economic point, that is next year is going to be a very good year. And as far as UK property is concerned, nothing is more important than GDP growth. Some of the other big themes that I'm pondering for the next 12 months, some are fairly familiar, some are not. My sort of dog ate my homework point is that, the trends from COVID are still very, very uncertain. Data is evolving. This is hopefully a once-in-a-lifetime experience. And I think, while I do slightly poo-poo all the chat about new normal, some things will change. I've mentioned GDP. And I think in terms of the international investor world, looking around the world for places to park its money, we're definitely getting a feel that globally that the UK is still seen as comparatively safe and comparatively cheap to some of those global investors, most notably the group that stayed away because of COVID and the group that stayed away because of Brexit. So I think we're in a relatively good position. The hot sectors, not a lot of change. Logistics is going to remain hot, but I think out-of-town retail is probably going to be the biggest year-on-year grower in investment activity, something that Fiera have already been actively involved in. I think we're going to see the definition of prime changing, and prime is going to involve a lot of E and a lot of S in the context of ESG. But I think we will all still recognise what makes a good asset or a good location going forward. I don't think that has fundamentally changed. And finally, I said I'm not particularly worried about consumer price inflation. I am very worried about construction price inflation. And yes, this is a global issue at the moment. But again, I think the fact that the UK government has delayed enacting the full changes in border procedures that go with Brexit till next July means that our hangover will be somewhat longer. Moving goods in and out of the UK will be more challenging for longer than perhaps they will be out of Germany. So construction price inflation, even before one gets into a debate about the cost of ESG, is going to be a challenge and will certainly delay or indeed defer completely some projects. In terms of big picture views on the three main commercial sectors, retail, I don't think anything really has changed. The big theme in retail pre-crisis was the rise of online shopping, and I think that will be the theme for the next decade as well. In a nutshell, I would hold retail that is not exposed to online, generally the bars on the left here, and I wouldn't be that keen on retail that is heavily exposed to rising online penetration, the bars on the right. And you can see why food stores, bulky goods, retail warehouse parks, all very popular asset classes throughout this crisis. And I think retail warehouse parks in particular, it was the first segment of UK retail where footfall went back to normal. I think not only has it proven to be online friendly, it is also proving to be comparatively COVID friendly. So one or two things there in terms of sectoral plays or thematic plays. I also think we're going to see the bottom feeders coming into the retail market quite soon. And here you have retail prime yields. And, you look at what happened last time to the prime shopping centre yields got up into the sevens. They came down very, very quickly indeed. And we are just beginning to see some counter-cyclical players entering that market. Previously, it was all about repurposing. Now we're starting to see people coming in and just saying, look, I can buy it. It's cheap. I will bet that it's going to be more expensive in a year or two's time. So I'm not totally anti-retail. I think there are reasons for investing. But, if you hate retail and you never go into a shop, obviously you've been buying logistics for quite a considerable time. My colleague who leads our logistics research team doesn't even rewrite the press release anymore. It just says another record quarter for leasing or investment activity. And sure enough, the last quarter or the year to the end of the third quarter was another record first 9 months of the year for logistics leasing activity. Good old Amazon in there, accounting for nearly 20% of that. And similarly, the first 9 months of this year was a record period for investment activity in this sector. I'm not convinced it's quite the slam dunk it might seem. I think we're ignoring technical obsolescence. I think we're ignoring the ESG challenges that are associated with logistics. Logistics, I think, is fine from an environmental point of view if you just look at the building. The moment you start looking at how the product got to that building and how the product is leaving that building, it becomes more problematic. And also it's very expensive. But if I was a betting man, I would say prime logistics yields will continue to harden in the UK. But for me, it is much more of a development play than an investment play. Generally, the commercial property story in the UK is pretty good, at least on the investment side of the equation. You would expect most measures to be up on 2020. Looking at the chart on the right here, commercial property investment volumes actually up on the same period in 2019, which is a good place to be. You can see on the right where this money is going, a bit less proportionately going into offices, continued rise of logistics and industrial, a bit of a tick up in retail warehousing, but other than that, no real changes on the sort of pre-COVID trends. So that's recovering nicely. The bit of commercial property that worries me is the office market. And this is data from a variety of the big property management firms looking at office occupancy in London and the top 9 regional cities. The far right bar is looking at the first week in October, which just happened to be the latest data I had when I put this together. No office building was recording office occupancy of higher than about 25% that week. Now, we're not trying to get back to 100% because no office was ever at that level. Let's say it was probably 65%. But I think the reason why the office leasing market is so quiet at the moment, and probably the last bit of the market to recover, is how, if you're the head of real estate at any big service sector company, do you plan for how much space you might need in 18, 24 months when at the moment your office is only 20% full and you don't know if it's going to stay that way. And I think we're going to see a sustained period of people trying to avoid making leasing decisions in the office market. Massive bias to prime. 90% of leasing activity in London offices this year has been of grade A space, and I think that will continue. And I do think, offices will rebound. Just looking at requirements, these bars show, who's looking for space in London at the moment and relating it to how much space they currently occupy. The majority of companies are looking for more space than they currently occupy, even in banking and finance. They just don't know how much more. And I think, that is going to drag on the office market going forward. I'm not going to go into ESG in huge detail. You can read these at your leisure. I think I will make one point, which is the penultimate hexagon here. I think we are still generally in the commercial property market in particular asking the wrong question about green premiums. We're saying, will tenants pay more rent for this? I think the right question is, how do we enable tenants to pay more rent for this? And I think if you can demonstrate that you have an asset that offers lower energy bills, no reputational damage to the occupier or tenant's brand from the building not being green, lower offsetting costs because the building is more efficient, then you can start having a conversation about you making some savings here. Does this enable you to pay more rent? But I think starting from this basis of saying, I must get more rent to deliver this kind of space is not going to end well. Where it's not going to end well, of course, is in parts of the country where the rents are just not high enough to deliver this stuff. And a large portion, particularly of the office market and the retail market, the rents are just not high enough to deliver high environmental quality buildings. And that is going to be a huge challenge for those who own those assets. That's the end of my quick intro. I'll now hand back to Damian to take over.
Thank you, Matt. Matt's in a quandary there, isn't he, between things that are worrying him and things that aren't worrying him. But that's what we're here to talk about. So before we get into a discussion with the panel, just a reminder to keep your questions coming through. And we're also going to make you work a little over the next few minutes by just putting up some poll questions, because we want to know what you think, and we want to put those questions to the panel. So the first question, sorry, I've gone back through Matt's slide there by mistake. Let me click through here. Actually, I think I can do it in a quicker way here. So, yeah, the first question is, if you have funds to allocate to real estate, will you be looking to increase those over the next 12 months? So if you do have funds to allocate to real estate, will you be looking to increase those over the next 12 months? We've got 3 questions. I'm just going to run through each of them and then go to the answers. So I'll give you an opportunity to fill them in. Hopefully you can do that quite quickly so you don't have to listen to me rambling on, and we can get to the discussion more quickly. So last prompt, if you do have funds to allocate to real estate, will you be looking to increase these over the next 12 months? Yes or no? I can see some of you are still filling it in, so I'll pause for a moment. Lots of you are filling it in, that's great. Okay, let's jump to the next question. So which sectors are you most interested in? And here you can pick 2 of residential, industrial, office, retail out of town, retail in town, and alternatives. For instance, student accommodation and hotels. So you can fill that in by picking 2 of those. If you need a reminder what Matt was saying there, he's not worried about retail that's not exposed to online. He's not worried about industrial, of course, but he is worried about the office. So I can see your responses coming in. I'll just give you another chance. You can pick 2 of these, and we'll get up to a similar number as we did on the first one. Perhaps it requires a little bit more thought. Okay, and let's jump on to the last question. What are the greatest risks to UK real estate values in 2022? And again, pick 2. Might that be persistent inflation, rising interest rates, excess investor demand for narrow asset selection, poor UK economic performance, the growing obsolescence of commercial real estate, post-Brexit issues, or COVID-19? So again, you can pick 2 of inflation, interest rates, excess demand, for a narrow asset selection, poor UK economic performance, obsolescence, Brexit, or COVID. And again, Matt wasn't worried about consumer price inflation. He was worried about construction price inflation, a little worried about indebtedness, about politics as well. Okay, I'll just give you a chance. The numbers are going up again. Excuse me. Okay, I think most of you have filled that in now. So let's have a look at some of the answers, and I'll bring in the panel to discuss these findings. So if you have funds to allocate to real estate, will you be looking to increase these over the next 12 months? Jenny, can I get your thoughts there as someone who's investing in a number of asset classes? Does that surprise you, and is it a view that you share?
Thanks, Damian, and good afternoon, everybody. No, it doesn't surprise me, Damian. I think in particular, when I think about all asset classes, I'm probably a CIO most worried about the pricing on fixed income assets. So I think the fact that real estate provides an income is a huge attraction. And I think also real estate provides an opportunity for investors with different risk appetites to invest in the sector, whether they want to go through development or just as a sort of income standing investment. The one thing that I would probably say is underneath that, I suspect that there's a lot of unpicking to do just in terms of the range of returns that you can get from the different sectors, but we can perhaps pick that up later on.
Yeah, let's just touch on that quickly as we go through these questions. When Matt talked about that, his different views on industrial, on retail, on offices particularly, were you nodding or shaking your head?
Yeah, no, I mean, I've never in my 30 years of real estate experience seen the breadth of variation, polarization between the returns. So broadly, I would agree with Matt. You know, I think it's it's pretty commonplace that the themes that get described for real estate are beds, sheds and meds. I'm with Matt that I worry a little bit about the pricing of logistics and industrials, and I worry too when everybody likes a particular sector, it makes me sort of want to turn and go in the other direction. I would agree that the distressed players are very much looking at retail warehousing and probably thinking about it with alternative uses in their mind. The area where I'm perhaps not maybe as sanguine as Matt is, I don't believe the office is dead, but I do think if you're investing in offices, you need to have a very clear view of the future of the office, how it's going to operate, and the old sort of way of owning an office, of letting it for 10 years, 15 years and not really worrying about it. I think office occupiers are increasingly going to have to become more operational in the way that they look at and very customer orientated.
Interesting. Are you in the office today?
I am.
Okay. There could have been another poll question, couldn't it? Alex, did I get your comments on this? Increasing allocations to real estate. Is that something you're seeing and feeling?
Well, I'm going to be honest, with the audience that was likely to listen, I figured the chances are there'll be more yeses than nos. So we have to take it with a pinch of salt. Turkeys don't vote for Christmas. At the same time, I also think, to Jenny's point, the real estate asset class is changing, and all of us are having to learn to become more customer-centric in the way that we manage whatever asset type we've got. And I'm sure in the next poll answer, you'll see where people want to put their money. Somebody talked to me the other day about landlords and tenants, and it made me realise that landlords is a term that comes from feudal times, hundreds, if not even thousands of years ago. We need to talk about owners of property. We need to talk about customers, and that's going to really change the way we think about real estate going forward. So even if people do want to allocate more to real estate, they need to think quite carefully about how they allocate it.
Okay, owners and customers, that's your preferred description for the two parties and the relationship.
Well, I'm open to other ideas, Damian, if you've got better ones as we go.
Okay, thank you. Right, let's jump on to the next poll question and get your reaction to that. Which sectors are you most interested in? Industrial is still attractive, and residential too there. So Matt, I won't ask you to comment on residential. I know you're a commercial specialist, but the audience seems more persuaded by opportunities in industrial than perhaps you are.
Yeah, I don't think there's anything wrong with industrial or logistics. I think there is no doubt that we will all be clicking, swiping, shopping, streaming more in the future. And, that means products, are going to get to us in a different way when we buy them. And probably means a massive increase in demand for data centres, which broadly would slot into an industrial category. I think we've slightly ignored the industrial bits in favour of the logistics bits in recent years. UK does still manufacture stuff and manufactures some very good stuff. But, the pricing for manufacturing warehouses, as it were, is slightly different to logistics. I just think, I'm a simple, old school, fundamental yield kind of person. The yield should reflect the forward rental growth expectations, not just the weight of money targeted at the sector. At the moment, I don't think it is. Does that mean I don't think prime logistics yields won't harden? No. And does that mean I'm worried about it? No. I think it's going to present a challenge for some fund managers, though. I think we're going to get to a point where if you are an ESG compliant investor, you're going to have to be talking quite a lot about the type of people you let space to. Despite the announcements from Amazon and a few others about they're planning on not using sea transport that is heavily polluting by 2030, there are massive challenges in terms of, the product that ends up in our warehouses. So there may well come a point where the types of tenants in logistics may not be quite as ESG blue chip as they seem. But nothing wrong with it. I build it rather than buy it is just the short answer.
Okay. And Alex, looking at this again, there's a symbolic tipping point here, isn't there, where alternatives are more interesting than offices all of a sudden. Surely they seek to be alternative at that point. But have you seen that tip recently?
Well, I agree with Jenny's point earlier that offices will have a place. They just won't be the same as it was before. It needs to be much, much better to attract people to come to work, certainly judging by Matt's graph earlier. In terms of alternatives, I mean, I'm surprised by how high that is, because those sectors are increasingly specialist. So hotels, other than Premier Inn, typically you take an operational component, and student accommodation, typically you're taking an operational component. These are skills that are not natural to the average commercial property owner, because it's not in our DNA, and it's not the way we look at industrial office or retail traditionally. So I'm surprised that it's growing, but at the same time, you can see how popular residential is becoming, another asset type that's going to require a mind shift in the way that we operate that asset class if we're going to succeed.
There is this move to operationalisation, isn't there? And Jenny referred to it in the context of the office. It's certainly there in residential, which build to rent perhaps has more in common with hotels than some other asset classes, and it's there in alternatives as well. Does that make some alarm bells ring for you, Alex, in that you referred to the need for specialists, that perhaps generalists are dabbling in sectors where specialism is required?
I think the alarm bells should only ring if you're an investor and it turns out your partner doesn't have specialist skills to undertake this, because you need a specialist, and you probably also need a premium for the extra risk you're taking, whether you know you're taking that risk or not, because it's an operational asset, not a vanilla FRI lease. So I think you need to look at that very carefully. But residential as a market type is 10 times the size of commercial. So to me, that has to be an obvious opportunity. And when you look at BTR, the built-to-rent sector in the UK, there was £1 billion transacted in Q1 of this year in a £8 trillion market. That's nothing. That's 100,000 units built today of purpose-built BTR. I mean, these are fractional numbers. I just also, one other point on industrial. We completely agree with Matt's comment that the game is about building the assets for the future. I think that's where you're going to make your money rather than chasing down yield. Okay, thank you. And Jenny, we touched on which asset classes appeal, but residential more specifically, is that something that you see as being very early in its growth story? And is it of interest to you as an investor?
Yeah, no, I mean, when we look around the world, residential is a sort of, in a real estate context, a pretty established sector in the US and in Europe. I think for me, for residential in the UK, it's, as much as we've had a little bit of momentum over the last few years, it's still quite nascent. And to Alex's point, getting the operational model right is really key. And I guess probably when I'm looking at potential residential fund managers, I'm looking at what is their operational skill base, how do they see the use of technology, how well aligned are they with people, and in some respects, how are they thinking about operational scalability, whether that's sort of nationwide, clusters within a town, or regional. So I just think, there's a lot there. I think it also brings a new component of probably reputational risk for us all to face into. But equally well, it's an area where all of us as investors can contribute to the wider society need. It's, I think for real estate people, they need to face into that, skill up, and real estate people need to look outside to bring in external resources and think about how they use data.
So hire experts or partner, perhaps. Okay, let's move on to the last poll results. What are the greatest risks to UK real estate values in 2022? So Brexit is still there, rising interest rates is there as well, risk of obsolescence as well. I'm going to go straight to the panel. They haven't had much time to digest this, but Matt, I'll ask you first. Rising interest rates and Brexit. You certainly talked about Brexit not being done. I think you touched on interest rates as well. Are they your top two?
No, definitely. Neither, actually, probably. I think obsolescence is my big concern. If we are going to stick to, for example, the potential target of EPC B or above for UK offices, that means 90% of the stock would be unlettable today if that came in now. And I think, a really worrying stat that I came across, just rootling around in the MSCI data last night is actually the amount of money landlords are spending or owners are spending on their assets as a proportion of capital value or indeed per square foot has been falling for 5 or 6 years. So I can understand the reasons why, but in the context of the government 600-page that was released last night, there are big challenges ahead, I think, around obsolescence, both in all areas of the built environment.
Thank you. And Jenny, what do you see as the biggest or the very big risks there?
I'm trying to be sort of contradicting, but like Matt, I was really surprised about the obsolescence risk because I do worry it's not properly factored into current valuations and pricing. But then I think probably my other main point is when you actually look at the range of returns, we go from 35% to 21%, I think. So actually, they're all there or thereabouts in terms of weighting. I think probably in a wider context, I would say we all investors, whether it's real estate, particularly on real estate, we also really need to think about society, community, and the contribution that what we're investing in adds to that. Because I do think the breadth of inequality that is prevailing in society could come back to bite us if we're not careful about it. So I know that wasn't there on the list, but that's another factor that I do worry about.
Yes, and Alex, overlapping with that. Sorry, Alex, go on.
No, I was just going to pick up on Jenny's point to say, if the E, S, and G, the S is the hardest for us to really think about and address, because the E, the environmental side, it's about location, it's about the building fabric, it's about the energy usage, to Matt's earlier point. The G, the governance, that's about are you a robust, thoughtful, process-driven manager that also has a flair and entrepreneurship that does it in the right way. The S is so difficult. It's about, when we develop buildings, we try to become part of that community through our local operating partner network and to embed ourselves so we're not just here today, gone tomorrow. But it is the hardest part of what we're having to do. It's also critical because if there's a them and us feeling between the property industry and the rest of society or between the owners and the customers, we're going to have a much bigger problem to face in the future. So, I think obsolescence is a huge issue as well, but I won't repeat the point the other two have made.
Okay, thank you. Let's move on from the polls now to some questions which have flooded in from the audience, actually, and some are specific and some are a little bit narrower. But here's a broad one to kick off, and this one's directed at Alex and Jenny. How do we find value when everyone wants to buy the same thing? Jenny?
I think you have to think about what sort of risks you're prepared to take and where you see the world going and what sort of time horizon you're looking at. I think I'm sorry, I'm slightly dodging the question because, I think it does depend on your capabilities, to the sort of discussions that we've had already about a preference to build to own. But I would probably be building to own to make sure that I've got fit for purpose for the 21st century that we're working into, or buying actually those brownfield assets, which in the course of the next 3 or 4 years, you can completely retrofit properly and do that in a carbon friendly way. I think, you need to be very cautious about paying top dollar for the prime asset now, because you could get it wrong.
Okay, before I put that question to Alex, that overlaps with a second question, actually. How do you address sustainability when so much is going to change in the years ahead? Is Build to Own the answer to that as well? Sorry, Jenny, that was to you again.
Why don't I take that in terms of if I'm still there? So I think in some respects it is, but I do agree with the questioner in terms of I do worry about the speed. You know, I'm optimistic about the fact that society is facing into climate change, but I do also recognise that, you know, technology and what we've seen with COVID, how quickly science can adapt, does mean that we need to be very conscious of the way the world is moving. And I'd probably encourage simple rather than complicated as a way of giving you some sort of flexibility going forward.
Okay, thank you. And Alex, same questions to you. How do we find value when everyone wants to buy the same thing?
Well, thank you for double stacking the questions, Damian. I've got to try and remember them both. In terms of the value, sometimes we feel like a 5-year-old soccer team as everybody runs around chasing the ball around the pitch. Whereas we know that when you get to a bigger and better soccer team, you're going to cover the pitch and players get positions. And so for me, it is a concern watching everybody running around chasing the ball. I think you either have to try to access different sectors or you've got to try to access those hot sectors differently. And now the first one, the problem with that is going into the life sciences or data centers, it's not really a very big market. So you can't really deploy successfully there. At least if you do, you'll probably move the market. So we tend to think differently, which is you have to address the hot sectors in a different way. For us, as you've probably heard me say, it's about logistics, it's about development. We can buy the land, typically 50% of it's off market. Yes, construction costs are a big issue, but that's currently being reflected in rental increases. So it just gets passed through the appraisal. And for us, that's a much safer way to address the logistics market than competing in the sort of secondary investment market. On your second question about ESG and preparing our buildings for tomorrow, should we start today or are we just going to waste our effort? I think the first point is if we wait, it may be too late. To use the Bill Gates analogy of the bath is filling up, we've got to get on with it at some point. And secondly, the earlier you start to increase the energy savings in your building through insulation or better use of energy, the quicker you can pass that saving on to your customer. So the more money you can return back, the more opportunity you have to deliver value in that relationship. And finally, location. If you make the wrong decision today on location, that's something you can't change. So it's important to get the right location, to start as early as you can, and in our mind, accept that technology will evolve, you will retrofit things. Technology A will be replaced by technology B, but you've got to start somewhere, and we think that's now.
Okay, thank you. And Matt, you're not getting away scot-free here. I've got a couple of questions for you. And we've got quite a few questions here, so I'll go through them quite quickly. Here's one on a 5-year view. Is equity or debt the best way of generating the best returns from the UK, starting now?
I'm not qualified to give advice on equity or debt, but if I was just talking about my personal view, equity.
Thank you. Alex, do you have a view on that? Equity or debt?
Well, we in the UK, we only offer real estate equity, although we do real estate debt elsewhere. I think if you want to be able to sleep every single night and take an inflation matching return, a couple of percent, debt's a great place to be. Unfortunately, lots of people want to generate real assets and real return, and that real return probably means you need to be in equity.
Okay, thank you. And another one for you, Matt. Has the government undermined the attraction of the UK as an investment destination, given its attitude to landlord rights during the pandemic? That's been a real controversy over the last several months. No,
because actually many countries around the world adopted some kind of protection for tenants, I think quite rightly, through the downturn, and as part of a whole package of things they did to keep their economies going and to keep unemployment low, or not as high as it would have gone. There obviously are questions about what happens when this starts to unwind and when the moratorium ends. I'm generally seeing very mature conversations between landlords and tenants, but landlords do want some of the money back. And it really is a sort of slight horse trade in how much will we collectively spend on legal fees if we take this to court, and how long is the queue? Will the queue be to go to court? Let's knock that off, the amount of rent you owe us, and that seems to be going reasonably well. So I don't think the UK stands out as any worse than anywhere else, actually. And I think that's a really important point generally, because I think when you look at, debt to GDP ratios, if we were dramatically worse than everywhere else, I would worry about the UK's attractiveness for FDI. Everyone's in the same boat. Obviously there will be inquiries about how we did this and why we did that, but on a sort of broad macro G20 global property investing type scale, I don't think we are any worse as an investment destination than we were before the crisis. And let's not forget, London offices have been the single most popular destination for global cross-border investment into real estate of any city in the world for all of the last 20 years. So we must be doing something right.
OK, I'll put that in your not worried box then, which I've been scribbling down. And then, Jenny, one last very specific question for you. Would you invest in the 10 free ports? Do free ports appeal?
I did see that question and you had me thinking, so good question. I think in terms of, we're seeing a lot of things going on with ports and freight at the moment. So as a general concept, I think it's not at the top of my list, but it's definitely there thinking about, but you also need to think about sort of ports in the context of flooding and all of those sorts of things as well. So a lot to get your head around, I think.
OK, thank you. I do have to move on, but I just want to get a one-word answer from each of you, or certainly not many words, please. And it's a great question. If you could only buy one asset next year, what would it be? You can name the asset, or you can get away with an asset class as well if you can't name the asset. Alex?
Land.
Matt?
A really good category-dominating shopping centre at a very high yield.
OK, and Jenny?
I would go for land in a global university city town.
OK, I can hear people writing down those answers, getting on the phone. OK, thank you for your questions. I'm just going to hand over to Alex briefly, and then I'll be back to wrap up. Alex, over to you.
Thanks, Damian. So I wanted to finish with a 1-minute infotorial for what we're doing at Fiera, just so you can understand. And this was written before we all met up, so hopefully it ties in. We're seeing in the UK a 50% growth in e-commerce in 2020 alone, and supply chains that are changing from Brexit. At the same time, our population is growing, the fastest growing major Western European country, and one of the densest European countries as well. So what are we doing about it? For our clients, we are looking to develop out both logistics assets, typically EPC A, BREEAM, outstanding or excellent buildings, and we're also looking to bring forward residential. That residential is both for rent and for sale. Again, trying to target to deliver net zero carbon housing. We think these are the ways that an investor can most make a risk-adjusted return from the opportunity. At the same time, on our income side, we're seeing that interest rates will stay low. They may tick up gently in the UK, but today's 10 basis points might go to 25 basis points. These are low numbers. But inflation will probably kick through increasingly, maybe not too high in today's 3%, may not be much higher. At the same time, we'll come under demand from all investors to have better buildings to meet tomorrow's environmental challenges. What are we doing? Well, we're creating and owning grade A assets, ones where we can believe in the income, both with a longer lease and through a high quality customer that's in that property for ourselves. We think these build sustainable buildings and sit at the heart of sustainable communities. So for an investor in our funds, we're either going to take you into the development game, probably in residential or logistics, or we're going to help you buy and own secure income streams that can give you a better risk-adjusted return than fixed income, and hopefully can give you some protection against inflation. So that's what we're doing, and if you're a client, please do phone up afterwards if you want more detail. Damian, back to you.
Okay, thank you, Alex. And these have clearly been an uncertain few years for the UK. But as we saw at the Global Investment Summit hosted by the Prime Minister and the Chancellor this week, to several rooms full of investors who, in the PM's case, he said, had $24 trillion of deployable assets. There's clearly not a shortage of money out there chasing returns, and hopefully these last 45 minutes or so have gone some way to give some positive reasons why confidence in the UK and UK real estate is justified. So thank you all for coming. Thank you very much for your questions, and thank you especially to Matt, to Jenny, and to Alex. Goodbye.